Stop everything. In the last 24 hours, over $10 trillion was wiped out of the gold and silver markets. Silver has crashed more than 30% in just 2 days, yet at the same time, China is screaming for silver and offering record premiums. This is not normal. This is not natural. And this could be the largest precious metals event in human history. I'm recording this right now at 6:30 a.m. on Saturday, January 31st, 2026, just after midnight here in New York. Markets are moving extremely fast, and things can change in a matter of minutes, which is why timing is so important. Before we continue, if you're getting value from this video, make sure to hit the subscribe button and turn on notifications so you don't miss upcoming updates. And drop a comment below. What time is it where you are right now, and where are you watching from? I love seeing how global this community is. Leave your location and local time, and I'll catch you in the next one. What we are witnessing right now is not a normal market correction, and it is not just another volatile trading session that will be forgotten in a week. This event has already broken a record that stood for 46 years, and that fact alone should force every serious investor to stop and pay attention. In the last 24 hours, an estimated $10 trillion was wiped out across the gold and silver markets. That number is almost too large to comprehend, but it represents the single largest liquidation event ever recorded in precious metals. Events of this scale do not happen in functioning, stable systems. They only occur when stress has been building silently for a long time and finally reaches a breaking point. Gold and silver are not speculative tech stocks or meme assets. They are the oldest forms of money on Earth. They have survived empires collapsing, currencies failing, world wars, and global depressions. For markets like these to experience a wipeout of this magnitude in a single day signals that something far deeper is happening beneath the surface. Liquidity did not simply dry up, it vanished. When liquidity disappears this quickly, it means forced selling has taken over the market, not rational decision-making. Positions are not being closed because investors want out, they are being liquidated because they have no choice. This kind of move shatters the illusion that precious metals trade freely in response to supply and demand alone. A natural market does not erase trillions of dollars overnight without a global catastrophe driving it. There was no war declared, no asteroid strike, no sudden discovery that gold and silver lost their monetary role. What changed was the structure of the market itself. Excessive leverage, concentrated paper contracts, and interconnected financial obligations all collided at once, creating a cascade that fed on itself. Historically, events like this mark turning points. They are moments when the old pricing system is exposed as fragile and unsustainable. The last time we saw liquidation on this scale, it reshaped how markets functioned for decades afterward. This is why this moment matters so much. It is not just about price, it is about confidence, credibility, and whether the existing financial architecture can continue to hold together under pressure. When $10 trillion disappears in a day from assets designed to preserve value, the warning could not be louder. Silver's collapse over the last 2 days is one of the most violent price moves in modern market history, and it deserves far more attention than it is getting. In a span of roughly 48 hours, silver has fallen more than 30% from its recent peak, plunging from around $122 to the low to mid-80s. Moves of this magnitude are extremely rare, especially in a market as deep and globally traded as silver. This is not normal volatility. This is a forced reset. When silver enters a decline this fast, history shows that the move is rarely clean or orderly. Sharp initial drops are often followed by extreme whipsaws, false recoveries, and additional downside as leverage is flushed from the system. The reason is simple. Silver is one of the most heavily leveraged commodities in the world. Futures contracts, options, ETFs, and synthetic paper claims vastly outnumber the amount of physical metal available. When prices begin to fall rapidly, margin calls cascade through the system, forcing traders to sell regardless of fundamentals. This creates a feedback loop where selling causes more selling, completely detached from real supply and demand. What makes this decline even more alarming is the speed. A 30 to 32% drop in 2 days is not the behavior of a market calmly reassessing value. It is the signature of panic and mechanical liquidation. Algorithms do not care about long-term fundamentals, industrial demand, or monetary history. They respond to price thresholds, volatility triggers, and risk limits. Once those lines are crossed, selling becomes automatic and relentless. Human judgment is removed from the process entirely. Historical analogs show that when silver collapses this quickly, the move often overshoots to the downside before stabilizing. In previous crises, silver has temporarily traded far below its fair value as paper positions unwind. That does not mean the metal itself is worth less. It means the pricing mechanism is malfunctioning. The current price in the mid-80s may not represent equilibrium at all, but rather a transient point during a violent purge of leverage. This is why it is dangerous to assume the move is already over. Markets rarely resolve stress this intense in a single wave. Additional volatility should be expected because the system is still searching for balance after years of excess. What we are witnessing is not the failure of silver as an asset, but the exposure of how fragile and unstable its paper market has become under pressure. At this point, it is no longer reasonable to describe what just happened as a purely natural market event. Price moves of this magnitude, occurring this quickly, do not emerge from ordinary investor behavior or organic shifts in supply and demand. They emerge when structural pressure inside the system reaches a threshold and something is deliberately or mechanically triggered. The pattern of this decline strongly suggests intervention, whether through forced liquidations, concentrated paper selling, or coordinated risk-off actions by large institutional players. Markets can be volatile, but they do not implode like this without an accelerant. The idea that millions of independent participants all decided to sell gold and silver simultaneously is not realistic. What we are seeing aligns far more closely with the behavior of leveraged markets under stress. When price is pushed below critical levels, margin requirements spike, collateral values collapse, and positions are forcibly closed by exchanges and clearinghouses. This process is not optional. Traders do not get to debate fundamentals or wait for calmer conditions. They are liquidated automatically. Once that process starts, it feeds on itself, creating the illusion of overwhelming selling pressure when, in reality, it is a chain reaction. There is also the issue of scale. The volume required to move precious metals prices this far, this fast, cannot come from physical holders alone. Physical silver does not trade in nanoseconds, and it does not flood the market overnight. The selling pressure had to come from paper instruments, futures contracts, derivatives, and synthetic exposure, all of which can be created and sold in enormous quantities with minimal physical backing. This is where the disconnect becomes obvious. The paper market is capable of overwhelming the price signal even when physical demand remains strong. History shows that similar events often occur at moments of broader financial stress, when liquidity is scarce and institutions are desperate to raise cash. In those environments, assets are sold not because they are weak, but because they are liquid. Gold and silver become sources of collateral rather than stores of value, at least temporarily. That dynamic has nothing to do with the long-term role of precious metals and everything to do with systemic strain. When all of these factors converge, leverage, automation, liquidity stress, and concentrated selling, the result is a price collapse that feels unnatural because it is. It is not the market discovering truth. It is the market revealing fragility. While silver prices were collapsing across Western exchanges, something extraordinary was happening on the other side of the world, and this is where the official narrative completely falls apart. In Shanghai, silver was not behaving like a metal in freefall. Instead, physical silver premiums exploded upward, sending a signal that directly contradicts the price action seen in paper markets. This divergence is not a minor anomaly. It is one of the most important warning signs in global commodities today because it exposes a deep fracture between what the price says and what the physical market is actually experiencing. Shanghai silver premiums surged to as high as $44.17 per ounce, nearly doubling in a single day. Even after pulling back slightly, premiums remained elevated around $38, levels that would be unthinkable in a calm, well-functioning market. At other points during the same period, premiums jumped again toward $29 an ounce, representing a 50% increase in just one day. These are not normal fluctuations. Premiums behave this way only when physical metal is scarce and buyers are competing aggressively for immediate delivery. This is where the lie becomes impossible to ignore. If silver were truly collapsing in value, if demand were evaporating, premiums would fall, not surge. Dealers would be discounting metal to move inventory. Instead, buyers in Shanghai are willing to pay massive amounts above spot just to secure physical supply. That tells us that physical silver is not flooding the market, it is tightening. The so-called crash is happening almost entirely in the paper realm, where contracts can be sold in infinite quantities without regard for actual metal availability. The Shanghai market matters because it is one of the most physically oriented precious metals markets in the world. Unlike Western exchanges, which are dominated by futures, ETFs, and leveraged derivatives, Shanghai is heavily focused on real metal changing hands. When premiums explode there, it is a direct reflection of supply stress. It means refiners, manufacturers, and investors cannot obtain silver at posted prices. They have to bid higher and higher and higher because the metal simply is not available at the paper price. This divergence exposes the structural weakness of the global pricing system. The spot price is supposed to represent the balance between supply and demand. But when physical buyers are paying $30 to $40 above that price, the spot price becomes a fiction. It is no longer a discovery mechanism. It is a reference point distorted by leverage, speculation, and forced selling. In moments like this, the paper price tells you more about financial stress than about the value of the metal itself. What makes this situation even more alarming is the timing. These premium explosions occurred simultaneously with one of the most violent silver sell-offs in history. That is not coincidence. It suggests that as paper holders were being forced out, physical buyers were stepping in aggressively, absorbing metal at any price necessary. This is how wealth transfers happen in commodity markets. Weak hands are shaken out through volatility, while strong hands quietly accumulate the underlying asset. The Shanghai premium is not just a regional data point. It is a signal flare. It tells us that the global silver market is bifurcating into two realities: a paper market under extreme stress and a physical market experiencing shortage. When those two realities drift too far apart, something has to give. Either physical prices rise dramatically or the paper market fails to deliver. Historically, these conditions precede major repricing events. This is why Shanghai matters so much right now. It is not following the script. It is exposing the gap between illusion and reality. And once that gap becomes visible to enough participants, confidence in the paper price collapses, not gradually, but suddenly. China's response to this event may be the most important signal of all because it removes any remaining doubt about what is really happening beneath the surface of the silver market. While Western headlines focus on collapsing prices and panic selling, China is doing the exact opposite. The message coming out of Shanghai is simple and direct. Silver is wanted, silver is scarce, and China is prepared to buy as much as the market is willing or forced to sell. That statement alone should stop every serious observer in their tracks. When China steps into a commodity market during moments of extreme volatility, it is rarely reactive and almost never emotional. China plans years, sometimes decades, ahead. It does not chase prices. It accumulates strategic resources when conditions are most favorable. The willingness to absorb silver aggressively during one of the most violent paper sell-offs in history is not accidental. It suggests that China views this collapse not as a warning, but as an opportunity. While leveraged traders are liquidated and forced out, China is positioning itself on the other side of the trade. Silver is not just an investment metal for China, it is an industrial necessity. It is critical for electronics, solar energy, advanced manufacturing, medical applications, and defense technologies. As global supply chains fragment and geopolitical tensions rise, securing access to raw materials becomes a matter of national strategy. From that perspective, silver is not cheap or expensive based on short-term price moves. It is valuable based on availability. When paper markets malfunction and prices disconnect from physical reality, buyers with long-term vision step in. China's willingness to pay extreme premiums confirms that this is not speculative behavior. No rational buyer would pay $30 or $40 above spot if silver were truly abundant and demand were collapsing. These premiums reflect urgency. They reflect competition for limited supply, and they reflect a recognition that paper prices may not represent real-world replacement costs going forward. China is effectively voting with capital, signaling that the current pricing mechanism cannot be trusted. There is also a broader geopolitical dimension to this move. For years, China has worked to reduce its exposure to dollar-denominated financial systems and Western-controlled markets. Accumulating physical commodities is one way to achieve that. Unlike paper assets, physical silver cannot be frozen, sanctioned, or digitally erased. It exists outside the banking system once it is in hand, in a world increasingly defined by financial weaponization that matters more than ever. This moment resembles past episodes where strategic buyers quietly accumulated resources while the market was distracted by volatility. History shows that these are often inflection points. When the dust settles, the metal has moved from speculative hands into long-term vaults, and it does not easily return to the market. Supply tightens further, volatility increases, and price discovery becomes more unstable, not less. What makes China's stance especially telling is its timing. This is not accumulation during calm markets. This is accumulation during chaos. That tells us China believes the chaos is temporary, but the value of the metal is permanent. It also suggests confidence that current sellers are acting under duress, not conviction. In markets, that distinction is everything. China's message, whether spoken explicitly or implied through action, is unmistakable. Silver is strategic, silver is scarce, and anyone willing to sell it at distressed prices will find a buyer. That is not the behavior of a market that believes silver is collapsing. It is the behavior of a power that believes silver is being mispriced, and that the window to acquire it will not stay open for long. The gold to silver ratio is one of the oldest and most reliable stress indicators in the precious metals market, and right now it is flashing a warning that should not be ignored. As this liquidation unfolded, the ratio surged upward toward 57.31, meaning it now takes more than 57 ounces of silver to equal the value of a single ounce of gold. On the surface, this may look like just another technical metric, but historically, sharp movements in this ratio only occur during periods of extreme imbalance, fear, or systemic strain. In stable markets, the gold to silver ratio tends to move gradually. It reflects long-term relationships between monetary demand, industrial usage, and investor preference. When it spikes rapidly, it is almost never because gold suddenly became vastly more valuable in real terms. Instead, it is because silver has been violently pushed down by paper selling, leverage unwinding, or forced liquidation. That distinction matters. The ratio is not telling us that silver has lost its relevance. It is telling us that silver has become the pressure valve of the system. Throughout history, spikes in the gold to silver ratio have coincided with moments when confidence in financial markets was deteriorating. During crises, investors rush toward perceived safety, favoring gold over silver in the short term. At the same time, leveraged positions in silver are unwound aggressively, exaggerating the move. This creates a distortion where silver becomes deeply undervalued relative to gold, not because fundamentals changed, but because the pricing mechanism is under stress. What makes the current ratio move especially concerning is the context in which it is happening. This is not occurring in isolation. It is happening alongside a record-breaking liquidation, collapsing paper prices, exploding physical premiums, and aggressive accumulation by strategic buyers. When all of these signals align, the ratio stops being just a number and becomes a warning about the integrity of the system itself. Ratios spike like this when markets are no longer clearing smoothly. Historically, extreme gold to silver ratios have not been permanent. They represent moments of imbalance that eventually resolve, often violently. In past episodes, once panic subsided and physical demand reasserted itself, silver prices rebounded sharply relative to gold, driving the ratio back down. Those reversals tended to catch most participants off guard because they occurred after sentiment had been completely crushed. The ratio did not normalize gradually, it snapped back. The danger for the current system is that this ratio spike is unfolding in an environment already burdened by high debt, fragile liquidity, and geopolitical tension. That increases the risk that resolution will not be smooth. If silver is being artificially suppressed through paper markets while physical demand tightens, the eventual adjustment may come not through orderly price appreciation, but through volatility and dislocation. In those scenarios, ratios do not gently revert. They overshoot in the opposite direction. The gold to silver ratio is often described as a measure of relative value, but in moments like this, it functions more like a diagnostic tool. It tells us where stress is accumulating and which market is absorbing the shock. Right now, silver is absorbing it. The ratio is rising because silver is being used to relieve pressure elsewhere in the system that is not sustainable indefinitely. When ratios reach extremes during periods of crisis, they are less a prediction and more a countdown. They signal that something is out of alignment and that the current pricing structure cannot hold forever. Whether the adjustment comes through higher silver prices, further breakdowns in paper markets, or failures to deliver physical metal remains to be seen. But the message from the ratio is unmistakable. The system is strained, and the longer the imbalance persists, the more violent the eventual correction is likely to be. What you are watching is not a collapse of silver. You are watching a collapse of the paper pricing mechanism. When physical premiums explode, when China hoards metal, when $10 trillion evaporates overnight, the message is clear. Price is no longer telling the truth. This is a price alert. This is a system alert. And this moment will be studied for decades.